All right, so we're looking at a weekly chart here. And if you recall, at the beginning of the week, on Monday's live stream, I walked you through the top-down analysis. I told you how we traded up into this premium sell-side imbalance, buy-side inefficiency. And we started this week here up around the high end of the candles, opening price. And I mentioned before we traded down here that this was where we would likely draw into this buy-side imbalance, sell-side inefficiency, this candle here. And we have seen that this week. On the daily chart, again, same imbalance from the weekly. You can see we've worked that several times so far this week. And there's an inefficiency down here. And I think that before we get there, we could potentially trade below these lows. Now, tomorrow's non-farm payroll. That is a highly manipulated day. So the data, in my opinion, is not as important because it's already baked into price. But the sentiment aspects that number captures the minds of investors and causes them to feel either bullish or bearish, or unravels their present bullish or bearishness if they're holding positions. So it's going to be a carnival ride like it always is. And at 8:30 tomorrow, everything's going to be moving around, a lot of volatility. But I think that going into next week, we travel to here and most likely try to work down inside this inefficiency right there. If I'm wrong, then it's going to need to trade above this candlestick's open for me to be bullish. So until that happens, this candlestick's opening price or lower, I'm bearish. All right, my students know that my classic point of view for a new trader, new student, is trade on Monday of the week of non-farm payroll, trade on Tuesday, don't trade on Wednesday, don't trade on Thursday, don't trade on Friday. All right, so here's Thursday's trading here on a 15-minute time frame. Here's Wednesday's trading, and here's Tuesday's trading. So you can see Tuesday, much better in terms of price delivery. Wednesday, consolidation. Thursday, consolidation. This is graphically depicting exactly why I tell brand new students don't trade this week. Now, it doesn't mean that you, if you have more experience, more understanding, and you have a model, and you're not going to go in there and try to trade aggressively with huge over-leveraged positions, it doesn't mean that you can't take trades. It just means that as a mentor, I'm trying to be responsible to remind those individuals that don't have a lot of experience, that might get wrapped up on something that they see in price action and then completely lose their bearings and potentially hurt themselves financially. But with that said, we have sell side resting below here. I think that's going to be a factor for non-farm payroll tomorrow. We've already upset the buy side here, relative equal highs. You can see that we did in fact run up there, worked that level, and then stayed in a nasty little consolidation and then dug down in, took the sell side here, and then consolidated into the close of the day. Here's a 5-minute chart of the price action for today. As you can see, it's it's gnarly basically. Comes up, hits the buy side mentioned on the 15-minute time frame, and then spends a long time just banging around. And this is exactly what I tell students to avoid. It's actually very easy to simply avoid this. No one told you that you had to trade today, but someone did tell you that you should avoid trading it, and that's me. But I know you don't like to listen to your daddy, so we're going to take a look at what this price has done here on a 1-minute chart. First, we're going to look at through the lens of regular trading hours. In the lower right-hand corner, you'll see that RTH. That means we're going to see the price delivery between 9:30 a.m. Eastern Time until 4:14 p.m. Eastern Time. So the previous day here, on Wednesday, that's the settlement at 4:14 Eastern Time. And then where we opened up at 9:30 today. So that's your opening range gap, defined by that separation between the two price points. In this rectangle here is essentially the opening range gap and the opening range. So the time and the gap. So the market has a mid-gap level here. So we opened, traded right back up to it. So 70% of the time, The gap will get filled to halfway. Again, you're still seeing that number going. I saw a guy posting on Twitter that someone did a study on it, and it doesn't live up to 70%. You can check your math, because I went back 40 years, okay? And I got data going back for decades. And also, I've been living it. So your data's off. The idea of it reaching back to 70% of the time, going to halfway of the gap, is a nice little scalping opportunity. But if we open up down here, it just means for the opening range, that means the first 30 minutes, bias is bullish. So it goes up to it here, pulls back down in, fair value gap here, rallies back higher, finds some support at mid gap, rallies up to previous day's settlement, another fair value gap, rallies up, and clears the buy side. Spends a little bit of time in here. It's exactly what you want to see, because this is accumulation of buy stops. Smart money is accumulating those for the express purposes to trade it short. The market breaks lower, comes back into this sell side imbalance, buy side inefficiency. So this candlestick's low. That's what you see this dashed line with. And this candlestick's high. That's this dashed line. And in the midpoint of that is consequent encroachment. That's this line here. So we had a really nasty back and forth price consolidation in here, and then rallies back above and trades into consequent encroachment of that sell side imbalance, buy side inefficiency on the 1 minute chart. Now let's take a look at it through the lens of a electronic trading hours chart. On 1 minute time frame, you can see that sell side imbalance, buy side inefficiency after the market has traded up to the buy side, breaks lower, comes right back in, and then later in the day, after all this chopping around here, it goes back into the lower half of this civvy. It does not get in the upper half. So that tells you that this is most likely going to be wanting to go lower. We have a nice pool of liquidity down here, and we have the middle of that weekly buy side imbalance, sell side inefficiency. That's what this line is here. So since we were unable to trade in the upper half of that sell side imbalance, buy side inefficiency, it's more likely it's going to break lower. So after displacement lower, we have a gap in here that initially I thought was going to be traded back up into, but I later corrected myself and saw that this was essentially a breakaway gap. And in this little consolidation, trading back up into all the wicks, if you do all the 50% measurements of that for consequent encroachment, it's reaching up into those. And then we break lower, attacking the sell side here, here, and ultimately down here, and then delivering to the consequent encroachment of the weekly buy side imbalance, sell side inefficiency, which is this blue rectangle area, which is what I taught you on Monday's live streamed top-down analysis on the weekly chart. After hitting that, it makes the low of the day, and the market goes off that and then consolidates into the afternoon. I want to take a closer look in here because I want to show you that I did in fact execute in that. Here is this consolidation trading up into all the candlesticks wicks in here. But in here, on the 1 minute chart, you can't see what I'm about to show you, but there's a inversion fair value gap. Over here on the 15-second chart, you can see this candlestick right there. That buy side imbalance, sell side inefficiency. Once we traded outside of it, it came back up into it, and I went short 6 contracts there at 20,010 3/4. Traded lower, one more spike up in here before taking out this candlestick's low, and I'll add 4 more there, and we broke lower. I took partials at 19,964.5. Traded into institutional order flow entry drill there. Broke lower, dug down into another partial at 19,925 even. Came back up into a fair value gap here. Sold off, down in, and I took 1 contract off at 19,882.25. About 3 handles or so away from the low of the day. And it's below the weekly buy side imbalance, sell side efficiency, consequent encroachment. The mid gaps inefficiency, that blue shaded area. And then I had 2 contracts running as a potential in case it wanted to break down further, but it ultimately came back and hit the stop loss on the balance of the 2 contracts at 19,941.5. So the difference is experience. The difference is understanding. It's not likely that you're going to have the experience to trade this and expect these types of price runs during the week of non-farm payroll. But over time, you will. But it's not responsible for me as a mentor to try to teach you to chase these types of moves when it's a lot more difficult to trade in these environments. Now, can I do it? Yes. But it doesn't mean that you should try to pretend to be the equivalent of what 30 years of experience yields to me. your best interest is to sit still and study these days and appreciate the level of difficulty it brings with it, because if you can't recognize that early on, you're going to have these high expectations, unrealistic expectations that you're going to be able to navigate well in these environments. Without someone guiding you, it's ill-advised.